Hi there, this is Julie Williams, Principal Broker with Elite Real Estate. And today I wanted to talk about purchasing your new home before selling your existing home. This question comes up quite often with sellers who are concerned that if they sell their home, they may not be able to find a replacement home that they're excited about, especially when we're in sort of a hot seller's market. So there are a few things to consider when looking at this. One is, do you own your home outright? Or do you have a mortgage, but you have significant equity in the home? Or do you have a large mortgage on your home? Obviously, that third one is going to be the trickiest one. But then we need to look at, if you do have a loan, can you qualify for two loans? If you have a great income, you may be able to qualify to have two mortgages at the same time. And though that can be really scary, it can be a great solution that you can purchase your new home, know that you've found the right home, and then sell your existing home and pay off that first mortgage. So that is definitely an option. Another option is just selling your home and then renting for a while. Of course, a double move is not very exciting for most of us, but it does put you in a really great position to be able to wait for that perfect home and then be able to write a really great offer when it does come along. Cash is always a great way to purchase a home. So if you have cash and you can purchase your new home, but you really don't want to, you'd prefer to have a loan, you could potentially purchase it with cash and then pay off, sell your first home and then pay off your loan if you have one on that home, and then finance your new home after you've purchased it. You definitely want to talk to a mortgage person before you started down that path, though, because you want to make sure your new home is something that you can finance. Another option would be to get cash from investments. You'd want to be really careful and again talk to your financial advisor about that, because there can be lots of steep penalties. But if you could temporarily borrow money from an investment and then pay it off once you've sold your home, that could solve your problem. One of the kind of go-to things that people always assume that they're going to do is write a contingent offer. There are some, that really does solve the problem. You can, the way that works is that you write the offer, you have your home either ready to put on the market or on the market, and you write the offer subject to you selling your home. So the seller has to agree to accept your offer subject to you selling your home. And I would say only maybe 20% of sellers are really willing to do that. And if they have a really hot property, they're not going to do that because they'll have other offers that are more appealing. But the problem with it really is that it takes the control away from that seller. Now they're reliant on you to properly price your home, properly market your home, and to be reasonable about accepting offers. So there's usually a contingency period in there of 24 to 72 hours where the seller keeps their home sort of semi on the market. It's sort of halfway on the market. It's a bumpable or contingent property at that point, and another buyer could come along and bump you. And then you would have 24 to 48 hours or 72 hours to remove that contingency. The problem is a lot of buyers don't want to even look at properties that they may be able to not get, even if they got excited and wrote an offer, and then they may not be able to get the property. So contingent offers can work really well, but they're not always the best solution. Having your home ready to sell and ready to go in almost any scenario is a good idea, though. Have it ready to go on the market so you can purchase your next home and be ready. Having a bridge loan is something that was pretty popular maybe 20, 25 years ago. It's not very common now. People still think of the term bridge loan and they think, oh, that's probably a great option. There are only a couple banks in town that will even do bridge loans. Banner Bank is one of them. They can be expensive. So the way a bridge loan works is you refinance your home with a temporary interim kind of a mortgage. It's a 6-month mortgage usually. But you have to pay all the closing costs. There's a 1% loan origination fee, and there's title costs and appraisal and all of those costs. And then that bank will finance your new home when you purchase your new home. But it can be expensive, and it's just not done very often anymore. Another kind of option to the bridge loan is a HELOC, a home equity line of credit. So you could either get an add-on HELOC, so if you have a smaller first mortgage, you could get a home equity line of credit to get you the cash you need for your down payment, but you'd still need to be able to qualify. The other way to use a HELOC is to get a first lien HELOC, and so you would refinance your entire mortgage with this home equity line of credit. And the benefit of that is that it's usually interest only. Same with the bridge loan, it's going to be an interest only payment normally. So when the lender is looking at your ratios, your debt to income ratio, that shows as a smaller monthly debt because it's just the interest portion. So that is an option. It's not going to be an easy solution necessarily. So the whole point of this video is to tell you to get a head start on that process and kind of figure it out. Talk to your real estate agent, have them refer you to a really great lender who can help you. They may have you go to your bank or credit union and talk about home equity loans. They'll also see if you can qualify to do 2 loans, and they'll look at the different options for you. So thank you for listening to my video. If you have any questions, please just let me know. If there are any other videos you'd like me to make, let me know that too. And again, this is Julie Williams with Elite Real Estate.